Now we'll be going even deeper into risk management. I know we've covered few things in the introduction part earlier in my lectures, but I'm still going to touch on some key things that you need to know in addition to what you've learned under the introduction to risk management. And the first thing I'm going to be talking about is your focus as a finance executive. What are your focus areas? Yeah, beyond you just managing the risk, it goes beyond that. What are the policies that you need to put in place? Yeah, and what areas would those policies be focusing on? The first one is you have to be involved in what is the type of business that your company needs to be doing, because your type of business will determine so many things. Remember, your inherent risk is embedded in the type of business. Is it service business? Is it production business? And if it's production, what are you producing? How is seasonality going to affect that? Regulations, what are the competitors in that place? So you have to take decision how you want to play based on those factors. And likewise, you need to have a policy on gearing. Yeah, and gearing, definitely two types. There's operating gearing and there is financial gearing. All of this you have to make a decision. Yeah. Operating gearing, you're looking at about your component of variable cost versus fixed cost. So take for instance, we are talking about labor cost. Do you want to hire on a fixed contract basis, which would be a fixed cost, or you want to hire on pay as you use, which means you're using labor and you are paying a variable labor cost. So all of that decision, has impact on the result and the success of the company, and you have to take a decision. Likewise, financial gearing. Do you want to follow M&M theory that says you should maximize debt, or the traditional theory, that says you should only look for the optimal level of gearing where your work should be minimal? That's some policies you have to put in place, because either way, you're not wrong. It's a matter of risk and appetite. Likewise, when you do your NPV forecast, level of precision of cash flow is very important. And you need to decide what level of precision are you looking for. Are you looking for a precision that is almost perfect, which means you don't even want to stick to just one method. You want to try 3, 4, 5 methods and be sure that all of them are pointing towards the same direction. Not that you have using NPV. NPV says don't do the investment, or do the investment. IRR is saying don't do the investment. Maybe payback period is saying don't do it. Yes, we know NPV is very good and the best. However, some people are so risk averse that they still want to be sure. They want several types of methods to point into the same direction. So you need to be able to say, okay, this is the level of precision of our forecast that we will use before we can decide on taking on an investment. So those are focus areas for your policy making place. Be sure you can explain them. And also, beyond that, you now need to definitely have a risk management framework, which I have discussed in detail earlier. This is about you being able to identify the risk. You must be able to assess it, respond to it or mitigate, and you monitor. All of that, we've looked at this in the earlier part of the recording. The only part I'm just going to speak on is the identification part, and the fact that in your investment appraisal, you need to understand that your risks that you're identifying can be categorized into 3 types of risk. You have your strategic risk. Some will be strategic, some are just tactical, and while some are operational. It's your appraiser, project appraiser. Every project has those 3 types of risks. All the risks you have, you can group them into those 3 categories. And when you're talking of strategic, you're talking about the country where you're operating, or you're talking of even the global industry, the industry where you're operating. Things like recession, political influences, What's happening with your competitors. Those are strategic risks. Yeah. Likewise, you can have some tactical risk, which is about the functions of the company, divisions. Yeah, failing. It's about the divisions within the company now. Maybe finance fails to do something, or contract fails to do something, or commercial or sales, they're not able to achieve the objective. Those are tactical risks. And you have the routine activities creating some risk for you called operational risk as well. Probably you're having an item breakdown like machine breakdown or people, yeah, recruitment issue. People are not able to perform to the level you expect them to perform. Capacity issue. Right. So you see, that's way to look at it. Look at it. Bigger picture is the country, industry, that's strategic. If you step it down a bit, then that is looking at inside the company, and that is tactical. And tactical, you're looking about the divisions, different divisions in the company having their risks. And operational is your daily routine activity, yeah, which will be tied to either people or the items, machine that you are using. Assessment, like I always tell you, is about you using the right response for appropriate risk. So that means you need to know the likelihood, that's what we always do, and the impact. And based on that, you will now need to respond. And for your response, if you remember, we look at the 40s, where we say based on the impact and probability, which is the frequency. If you put that in matrix, if you put impact here, and you put likelihood, which is like frequency, yeah, low, high, low, high. I said if both of them are low, then you don't have any problem. You can tolerate it. You don't need to do anything. But if the likelihood is low and the impact is high, then you have to transfer it, because when it happens, it can wipe you off. You don't want that to happen, so get insurance. If likelihood is high, impact is high, it's not a place where you want to operate. Leave the place, avoid it, terminate. But if the frequency is, or the likelihood is very high, but when it happens, the impact is quite low, you don't want it to happen, because if it happens so many times, the impact that used to be small can become big. So give it some treatment. And this is where we'll be spending more time. Treatment. How can you treat risk? Depends on the type of risk. Like we said, if you're talking of political risk or you're talking of economical risk, all of this you can diversify. So that's one way of treating risk. You can diversify. If you diversify, which means you make sure that the portfolio contains items that are not correlated. By means of correlation, what I'm saying is that they behave in different ways. A factor does not affect all your portfolio items in the same way. Because if that's the case, then it's either you make loss or profit. You are not having a hedge portfolio. You have to have a balanced portfolio so that if there are some losses, there are some gains, and you hope that some gains will be more than some losses, but not that you're going to have huge loss or huge gain, right? So that is what diversification is all about. And apart from diversification, especially for political risk, there are a lot of things you can do. You can think about getting an agreement with the government where you want to operate. You can get consultants to help you review the political risk and manage it. You can even try and buy the locals into your business by maybe you give them some ownership, so that they are also having skin in the game and they will be happy to protect your company. Yeah, or maybe you make them vendors so that they're also benefiting from your company, so they can protect your company. Yeah, like I said, you can have government agreement, maybe on repatriation or on some policies that can protect you. You can also get consultant. You can even have a dedicated division within you so that they spend time reviewing that risk and managing the risk. So that's for those type of risk. But in our project appraiser, it goes beyond just risk. There are other forms of risk that we look at. And that's why we said that We must be able to manage our risk involved in our cash flow forecast, and likewise, even the financial risk exposure of that company. So, for forecast, it's something we've dealt with so much earlier on, where I spoke about, especially in FM actually. When I told you that if you projecting, yes, we know that our cash flow that we are projecting is never going to be the same as the actual. So we know that. So let me quickly deal with this quick refresher. So risk involved in your cash flow. Yeah, we said why. Why do we need to manage that risk? Why do we need to manage it? So this is managing this risk. But why do we need to manage it? We said we need to manage it because our forecast will never be the same as the actual. You can only get as close as possible, so which means this will always have a difference. So the answer to this why is because we want to minimize this difference. So which means we want our actual to be as close as possible to the forecast. Now, the question is, how do we minimize? How? And those are the methods we looked at in FM. We spoke about expected value. And for expected value, remember I explained to you, it's about calculating the likelihood, which is the probability, multiplied by the outcome. That is what expected value approach is doing. So because you know that even if you are not sure, but you can decide on how likely is it going to happen. Take for instance, we say there's a 40% of having a revenue of 20 million and there's 60% of having a revenue of 10 million. Then if you want to do your forecast, your revenue is not 20 million, neither is it 10 million. You're going to multiply the likelihood by the possible outcome. Yeah, this is the possible outcome. If you do that, that is 8 million. And we multiply 60%, which is the probability, times 10 million, that is 6 million. In that case, your revenue to use for your forecast will be 40 million. That is what expected value is all about. But sometimes you have a dependent probability, which means year one, let's say this is year one. Year two can be different because year two can now depend on each outcome of year one. So year two can say if year one is 20 million, then there is, say, 25% of making 4 million in year two. There is 40% of making 2.5 million in year two. And there is 35% of making 2 million in year two. That is if year one is 20 million. But if year one is 10 million, yeah, then there's a 30% chance of making 3 million in year two, and there will be 70% chance of making 1.5 million in year two. So in year two, what revenue should you be using? So that is what I was talking about when I said some dependent expected value. You need to also know how to work around it because you did not do that in FM, and that's why I'm showing that here now. Oh, we actually did something similar. But anyway, I'm doing a refresher now, so pay attention. So what this means is that, first of all, you need to calculate this expected value. When you know this expected value, it doesn't stop it. Then it means you have two possible outcomes at this probability. Because what's the probability of making 20 million? The probability of making 20 million is 40%. 10 million is 60%. So that means there is a 40% chance of making this, and there is 60% chance of making this. Then you need to do another expected value. So let's start with the first one, which is this part, this expected value. So to calculate this one, the same approach we're going to use that you are used to. So which means we're going to get 0.25 times 4 plus 0.4 times 2.5 plus 0.35 times 2. And that gives me 2.7. The same thing we're going to do for this one. 0.3 times 3 plus 0.7 times 1.5. And that gives me 1.95. Let me just check that my calculator obeys board mass quickly to be sure of those figures. 1.5 times 0.7, that is 1.05. And yes, so it obeys board mass because this is 0.9. Good. So we're good. So there's 40% chance of making 2.7, 6% chance of making 1.95. So which means year 2 revenue will now be equals to 40% times 2.7 and 60% of 1.95. So if you do each of them, 2.7 times 0.4, that's 1.08, and 0.6 times 1.95, 1.17. Then the total is 1.25. So which means the revenue for year 2, yeah, when you're doing your forecast, will be expected value of 1.25. Can you imagine? No, 2.25, sorry. And that is it. Even if you have 3 linkages or 4, that is how you go about it. You just put it on a tree like that and break it down, and you should have your expected value that you need to use for your projection. So that's the expected value. We looked at another method under AFM, which is sensitivity. And the principle behind this one is the fact that you need to know your margin of safety. This is about margin of safety. So for each variable, you want to know how much change can you tolerate and still stay within your decision. Take, for instance, NPV is positive. You have said do the investment. But what if revenue changes? How much change in your revenue can you accommodate without changing your decision? That is what margin of safety is calculating. And that's why we said this is calculated by dividing the NPV of the project by the present value of cash flow of the item of variable that we're trying to sensitize our NPV against. And if you look at lecture 31, please just go to the FM video, lecture 31. You will do a full refresh on sensitivity analysis. Please, it's a must. You need to be comfortable with sensitivity analysis. All the methods are there as well. Yeah. Another method that you can use to manage your cash flow in investment appraisal is simulation. And the popular one that we always talk about is Monte Carlo simulation. Yeah, and what's this talking about? This is better than sensitivity, because in sensitivity, only one variable you can do at a time. One variable at a time. So you want to see how your NPV will change when one variable changes at a time. But in simulations, you can do various variables at a time. Many variables you can do at a time. So which means you don't need to just do only revenue alone. You can change revenue, change fixed cost, change discount rate, and see what that means for your NPV calculation. And that's why it's much more powerful than sensitivity analysis. Yeah. So and what do? All you need to do is just keep changing those variables And every time you are changing them, you are getting NPV. All those NPV, you plot it until you have a distribution, preferably a normal distribution. So you're going to have several distributions. Yeah, you can have something like that. You can have something that's even almost on the negative side. But you're just doing many simulations until you have all those distributions. And you can see what this is now showing you is that you need to choose how much risk you want to take based on what your outcome is looking like. If you look at the one in blue now, the one in blue is showing that you have a window of high NPV. So let's say you have your NPV here on x-axis, and you have the likelihood, which is the frequency, on y-axis. They say that you have high likelihood of having NPV in this range. However, you can see that maybe not so much NPV like green. Green will give you the longest, you can see, and extend to this point. So you stand a chance of making NPV at this level, but look at the frequency, the likelihood, very low. The highest you can have here is here. And this even have a possibility of having a negative NPV. So if you want to take risk, you say, oh, you go with green. Green is what you want. Though the likelihood is very low, but you stand a better chance of making a lot of NPV, high NPV. Like a max person. You just want to maximize the return. You are maximizing your risk. You don't care. Right. So simulation is just looking into that, and the decision is taken always based on risk appetite. Based on risk appetite. Very important. So that's where we end it for the risk management on the cash flow forecast. Now, let's look at the second dimension that I mentioned, which is on the financial risk. How do we treat financial risks? Remember, I always tell you financial risk, anytime you hear financial risk, think of market risk, think of liquidity risk, think of credit risk. Those are popular financial risks. However, in this paper, when we're talking of financial risk, our focus in this particular topic is the market risk. Which means we are looking at changes in three things and how do they affect us. So we're saying these are the possibility of losing money. Remember, that's why it's a risk. Possibility of losing money as a result of changes in price of commodity, FX rates, or interest rate. When any of these three changes, there's a possibility of losing money. And because of that, we need to treat that possibility. We need to minimize our exposure. We need to manage it. And how do we manage it? How do we manage it? How do we manage this guy? Yeah. All these three guys, how do we manage them? What do we need to do? Two methods I'm going to be talking about. The first one is the value at risk, which we call VAR. Please, for the football lovers, this is not video assistant referee. It's VAR as a VAR, value at risk. And what is value at risk? This is just simply telling you your maximum expected loss. However, not with certainty, with some probability. So, once the probability is just a chance, it's not certainty. However, you want the chance that is quite high, like possibility that is quite high. So, usually we use high confidence level. So, I would say anytime you hear value at risk, think of maximum expected loss. At a particular confidence level, that's your probability. And also not forever, it has to be for a period of time. So you need to have a period, maybe 1 year or 2 years. Yeah. So this is about time. This is about probability. And this is about value, amount. So see, these three things must be present in your VAR. So take for instance, if I say my VAR at 90% confidence is equals to 5 million. And let's say my portfolio, which means my investment, is valued at 15 million. Because you need to know how to interpret VAR. It's very, very important. What I am saying here is that the maximum loss is 5 million at 90% confidence level. That's one way to see it. If you understood what I've said properly, you also agree with me that another way to see it is to say that there is only 10% chance of making loss above 5 million. Yeah, I'm sure you agree with that, because the sum of your probability must be equals to the sum of probability of all your outcomes must be equals to 1. And that's why these are saying the same thing. Another way to say it, you might also say it like you only have 10% chance of losing your entire portfolio. And there's a 90% chance that your portfolio will always have a minimum value of 10 million. Because if you cannot lose more than 5 million, then you are guaranteed 10 million at 90% confidence level. So think about it, and you can play around your interpretations, but it's very important for you to understand that interpretation. Yeah. But remember, this is at what period? We always need to put a period. So for 1 year. So in a year, you can't lose more than 5 million. And there's a formula for it, because you might be asked to calculate it, or you might need to calculate it. Yeah. If you're managing a portfolio risk using VAR, you need to know the VAR of that portfolio. And that annual VAR is equals to your confidence interval value multiplied by standard deviation. This confidence interval value will be given. It's a value similar to Z-score that you have to pick from a table under the confidence level. Just the same way you are using present value table, that you go to present value table, look at a number, at a percentage, at a year. But this time around, you won't have to pick it yourself. The question, the exams will have stated it for you. So just for you to pick the value, multiply by standard deviation. The worst case they can do is to give you standard deviation in variance. Then you have to calculate the square root of variance to get standard deviation. And this standard deviation will always be in value amount. And I'm going to solve a question on it later. Right. And confidence level also is going to be a value that will be given to you. Yeah, but that is annual VAR. But most times, remember, we are talking about investment appraiser, where we have projects lasting as long as 2, 3, 4, 5, 6, 7 years. How do you calculate VAR? So for projects, please take note. The formula is slightly advanced. So if it's a project you are doing, the VAR formula is different. In that case, you need to multiply the annual VAR that you have by the square root of the number of years of the project. So take, for instance, I give you a quick warm-up to say confidence interval value is 1.25. Standard deviation is $6 million. And the project tenure is over 3 years. It means the project VAR is simply equals to 1.25 times 6 million. This is annual VAR. Then I need to multiply by the square root of 3. And if you do that, you realize that your project VAR is $13 million about. And I hope this is making so much sense to you, because it's extremely important that you are able to break down your VAR into your interpretation. So what we're saying is this 30 million is the maximum loss that project can suffer at a confidence level that gives this 1.25. Let's say if it was 90%. Remember, the question was stated for you. If it's 95%, you will say it. And that is quick one on VAR, value at risk.